How can you initiate a process of change in your company in a way that's both fast and controlled? Where fast execution and excellence are no longer just a challenge, but a requirement. At Vermeg, this is what we have been offering our customers every day for over 25 years. Technological excellence through software solutions to accelerate and control your digital transformation. We are a leading technology provider to the banking and insurance sector. Every day, thanks to our solutions, we support you to meet the challenges of your digital transformation for more connectivity, agility, and security. Today, Vermeg's integrated platform allows you to adapt to increasingly complex and evolving challenges through the client experience, oriented and innovative solutions centered on data in accordance with current regulations, and through development tools to accelerate the implementation of high added value projects. We are more than 1,000 collaborators, driven by the same passion and the same vision. Software leaders in finance to accelerate your digital transformation.
Well, hello again, and welcome to the new joiners that have joined us during the course of the morning. I'm told that we're getting lots of people joining throughout the day. So what I'd like to start with is just reminding you and letting people who've just joined know that you get the facility to ask the panel questions. That's by clicking on the button on the right-hand side of the virtual platform. And some of the sessions, including this next one, will have polling questions. I know the last one on CSDR did. To access those, there's a button on the right-hand side, I think just beneath the questions one. So please go and have a look there when your moderator asks you to. Anyways, it's time to switch gears a bit now, and we're going to move away from specific regulations to the world of collateral and optimization. And in all my years in the business, I doubt there's been one conference that hasn't had a discussion on collateral. That got me thinking that I'm probably so old that the first of those events that I went to was even before some of you on this conference were even born. But before I start to spiral live into a state of deep depression on air, let's move on quickly. Well, you might think that the discussion should be done by now, but this area evolves and continues to develop as the use of collateral spreads across the wider financial markets, and market participants continue to optimize the way they just manage and trade collateral. So I'm now going to pass on to our panel session, and I'll introduce our moderator for this session, Jonathan Adams, who's Managing Principal of Securities Finance and Collateral at Delta Capita. Thank you, Jonathan.
Thank you, Kevin. Good afternoon, everybody. Welcome to the Collateral Management and Optimization panel discussion. As I say, my name is Jonathan Adams, and I'm your moderator for this session. Today's discussion will focus on the challenges firms face with collateral optimization, with some insights on possible solutions. Before we start, let's introduce the panelists. I think Gabby's first.
Hi, everyone. My name is Gabby Mantle. I am the post-trade collateral product lead at EquiLend. And in my 17-year securities finance career, I've worked mainly on the borrower and the prime broker sides. Within securities lending, I've managed teams covering all lifecycle processes, including settlements, margin management, collateral optimization, and billing. And then in prime brokerage, I was responsible for setting up a client assets and rehypothecation control group, easy for some to say. I moved to EquiLend just over 2 years ago.
Okay, Alan.
Hi. Yeah. Good afternoon, everybody. My name's Alan Sheehan. I now work for Adenza, entity of Calypso Technology and Axiom SL. I've worked for Calypso almost as long as Gabby has been working here, where and securities financing solution. Before that, I worked for a number of banks, including Dresden.
I think we have Wassel next. Thank you, Alan.
Hi, so my name is Wassal Zaman. I'm working at Vermeg. I'm heading the product strategy for the collateral solutions at Vermeg. One of the solutions is called Colleen, that you might know, ex-Lombard risk product. And I spent more than 20 years with the software vendors in the capital market activities, leading vendors to generate revenues and to service our different clients in the financial industry.
Thank you, Wassel. Martin, please.
I manage product management for securities finance and collateral management at Broadridge Financial Solutions. I think I'm getting on for 25 years experience in capital markets across both firms and across both banks and software vendors. So like Alan, I also worked at Dresdner Kleinwort, where I managed securities finance and treasury IT. I've also worked in quite a few other asset classes other than securities finance. So I've covered repo, prime brokerage, FX, and quite a few others. So it's interesting to have a discussion on collateral management, which touches basically everything in capital markets.
And finally, Ted. Thank you, Martin.
Last but not least, hello, I'm Ted Allen. So I look after business development for FIS, specifically focusing on securities finance and collateral solutions. I'm not going to tell you how long I've been working in securities finance and collateral, because that's just too painful. But I have been talking at many of these conferences about collateral optimization specifically over the years. I guess latterly, two projects I've been focusing on. One is our next generation Global One initiative, which I'm sure many of you are already aware of, and secondly, a new offering in specifically this space, which is our global inventory and optimization platform.
Thank you, Ted. All right, we're going to set the scene with the first poll question. So I think, are we going to get that on the screen? Okay, well, the question itself is, who is responsible for collateral optimization in your firm? The first option answer is Treasury, managing liquidity and funding in your firm. B, margin or collateral operations. C, XVA, ALM desk, managing initial margin and variation margin. So whilst we're waiting for those to come in, Wassel, could you give us your views on that, please?
Thank you, Jonathan. And thank you, SLT, for the choice of the topic. Indeed, collateral optimization has been a hot topic for many years, but now it is a reality because many firms have already invested in the topic, and especially on the sell side firms, and people are investing currently in the collateral optimization. And if we, while the poll results are coming, if we try to come back a little bit in the past and see to understand why it's important to invest, I think many drivers were behind that. Maybe if I list two of them, the first one would be the regulations that have impacted heavily collateral management and has increased the demand for collateral and more particularly the high quality assets. So there's an increased stress on the utilization of the existing assets. And the second maybe driver is of course during the last decade, collateral management has transformed from a risk management and a regulatory compliance function to a more strategic initiative with a strategic approach. So collateral optimization today can achieve potential returns from collateral transformations. It can help manage and support the liquidity metrics. It can also reduce the cost of your collateral funding and your collateral TCO in general. So that's why what we have seen is that the collateral optimization, depending on the team who's running that, you don't have one optimization, but you have many optimizations depending on the objectives and that the firms are looking to achieve. And also you need to put in place in front of that the corresponding operating model in terms of people, the teams, which team should run that. And I can see the result here that, 70% is the collateral operations, 20% is the treasury, and 10% is XVA ALM desks. So, of course, the team, the people, and you see here that different answers has different, backgrounds, meaning that the operations, there is still a need to reduce the cost of the collateral. There is still a need to reduce, to have the cheapest to deliver, to make sure that you are optimal. And this is part of the equation. And also, we are moving also, we have seen a lot of treasury departments look into having an overall look to the inventory and then look to the liquidity ratios, liquidity metrics. So at the end, I'm saying that the operating model, depending on what you need to put in place, need to look to the people and the teams, need to look to the data. And we'll talk with our co-panelists about the data later and the challenges about the data. The processes, how you would like to optimize, is it pre-optimization? Is it a post-optimization? Is it, how am I going to be optimal during, it's a journey, optimization during the time continuously. And finally, of course, you need to think about the technology and have the tools that are flexible enough to cater for all those collateralizations objectives, and make sure that the data you're receiving can be used as any parameter of the data that can be ingested, can be used as a parameter for the optimizations afterwards. So these are the challenges, I think, that are behind the collateral optimizations today.
Thank you, Wassel. Martin, what are your thoughts? You're still on mute.
Yeah, I think I just reinforce what Wassel said. One of the key objectives is actually getting people internally to agree on what is the objective of your optimization. You could be optimizing just within a pool of assets for a collateral management team. It could be optimizing across multiple business lines or multiple funds if you're on the buy side. And with those, it's actually looking at things like what's the cheapest to deliver, or you can actually scale up to, are you trying to optimize across your entire inventory, including uses such as repo and lending? And that's the point where collateral optimization starts actually merging in with trading. I think to get all that working, obviously you need, particularly at the more complicated and higher levels, you need agreement internally on things like transfer pricing, because you have various sources of collateral within a firm or a group of firms, and you have the users. So the sources need to be appropriately rewarded for them to actually buy into a firm-wide optimization model, and the users need to actually have the right charges to them. And then again, totally agree with Wassel. The importance then of actually getting all the right data in the right place in a timely manner, so you can actually do the optimization based on correct and timely data, including your agreements, your CSAs, your inventories is really important. If you're trying to optimize based on wrong or stale data, by definition, you're not going to get an optimal solution. And then finally, again, once you've actually got all that figured out, including operating model dimensions like transfer pricing, then you actually come to the question about what's the appropriate technology to drive that optimization process. And sometimes that's technology that you would be using directly, and there's also a lot of outsourcing of optimization as part of outsourced collateral management these days.
Thank you, Martin. Ted?
Yeah, thanks. I think that the poll question around who is responsible for the optimization probably does depend on what we just talked about there, right? What sort of optimization are you talking about? So if it's particularly in the derivatives world, if it's a pre-trade optimization, looking at what type of trade should I do to achieve a certain risk profile? Should it be cleared or bilateral? Which broker and CCP should I choose if it's going to be cleared? If it's bilateral, what's the optimal counterparty given my current profile with each of my counterparties and the headroom that I might have in thresholds and so forth. That type of pre-trade decision making is all around. It's a part of the overall cost of trading calculation, which would typically sit at the XVA desk. The post-trade optimization is then really around collateral optimization or inventory optimization. And as Martin just said, it's these things are really merging together now, and so we tend to talk more about inventory optimization kind of globally. When you look at your portfolio of assets, how should they be deployed across your lending program, your liquidity requirements, your collateral requirements, and so forth. That is, these are economic decisions which more and more are taken in front office or treasury. I guess historically, allocation decisions around collateral have been done often in the collateral operations world, but that's really changing and moving more towards a front office activity.
Thanks, Ted. So it's really, I think the general answer is it's not clear, and there are multiple stakeholders within a firm that are responsible for optimizing in some way, and many firms do it differently as they have different needs and perspectives. So that leads nicely onto our second audience poll question, which is, what is your firm's priority when it comes to collateral optimization? So answer A is pre-trade optimization to reduce regulatory initial margin requirements. B, post-trade optimization to make best use of inventory. C, equal priority. And D, no optimization. And I think Alan is our first panelist to answer this one.
Yes, thanks, Jonathan. Can I just check everybody can hear me okay? Because I had a little mic problem and had to swap.
Yeah, we can.
Okay, thank you. I think in answering this, I'm probably going to repeat some of the things that some of the other guys said, particularly Ted, but maybe I'll go in just a little bit more detail. Probably everyone has an opinion on the question of what is optimization, what's the priority. And to be honest, I think they're all likely to be different. I think none of them are likely to be wrong. And I'm sure, in fact, that every one of us on this panel is going to have a different view on that. I wanted to kick off before we look at the answer to the poll by talking a little bit more about the pre-trade aspect. And I think with UMR Reg IM really starting to impact the buy-side firms in phase 5 in an estimated almost 1,100 firms falling into phase 6 in September 22. Together with the other regulations that are impacting the sell side, like SACCR, the standard approach to counterparty risk, collateral information has become more and more central to the trade pricing. Certainly seeing firms carrying out and looking to carry out more what-if analysis to decide some of the things that Ted mentioned, who they want to trade with, how they want to trade with them, where they want to trade. And some of the components will be, is the trade cleared or bilateral? If uncleared, is there a CSA in place? Is it a pre-CSA, a full CSA? What's the threshold utilisation? What's the quality and therefore the cost of the collateral that must be posted as Reg IM? And normally, clearing will be cheaper than UMR Reg IM, as the cost of cleared margin will be less than either SIM or scheduled IM because of the difference of the treatment of things like the margin period of risk. So the MPOR is 10 days when facing a bilateral, facing a CCP, but also which is 20% party, but it's only 2% facing a CCP. And then there's additional things, little charge facing a CCP. And we're also seeing firms backloading their transactions for novation to the CCP and to change the UMR phase. But it isn't always the case that clearing will be cheaper than bilateral. Not quite as clear cut as that. And if you are trading on a bilateral basis and you haven't used your threshold, then there's no IM. So just let me stop there and just look at the answer to the poll. And I can see That's the poll is, we have 11% saying pre-trade, 22% post-trade, and then 56% saying equal priority. So of course, that shows that the post-trade optimization is as equal to, or more important to consider. And this, as the previous guys have said, it's about how to make the best use of your inventory. So your available assets that you have to cover all of the different needs. And there's been a significant increase in the amount of initial margin. And we know from a regulatory point of view that has to be segregated. But it's not only the UMR for bilateral IM, but also for cleared OTC IM. And in preparation for the panel, I was looking at the ISDA year-end survey of the margin requirements. And it showed that the Reg IM posted and received by the top 20 firms rose from $149 billion in 2017 to $260 billion in 2020. And in that same period, the amount of IM collected by the CCPs for IRD and CDS products rose from 109 to just over 330 billion. So by the end of 2020, we have almost 600 billion of segregated for initial margin. And I've excluded for VM, and I've excluded that because it's very difficult to know the amount of reuse that are being delivered to CCPs for ETD because they're not part of the ISDA survey. This shows the increased need for banks and buy-side best possible use of the assets that they have available for financing or for collateral management purposes. Make is in the Reg IM, the IM has been almost moved in the tri-party agents. Cases 4 and 5, tri-parties segregating IM. But again, here you need to ensure that you're managing your tri-party long boxes, filling them. For me, it's just another optimization challenge.
Thank you, Alan. We had some troubles with your connection there, so you were cutting in and out. So probably need to check that. Let's move over to Gabi. What are your thoughts, pre and post optimization?
Sorry, I was on mute.
No worries.
So I think really to echo the theme that's been covered already, knowing actually from the audience that there is equal weighting on the pre and the post, I think is interesting. From a securities lending and SBL specific perspective, we've really been focused on our clients. What we hear in the markets, we're really focused more around that kind of that post trade, and it's really in terms of understanding what the needs are, probably across an exchange within a venue for margin requirements, really, and then in some cases and in certain aspects being able to actually benefit from netting margins across a same venue. So definitely within the securities lending specific world, we are seeing a lot more around the post-trade optimization. Of course, pre-trade optimization becomes a factor because more demands on optimization in general, collateral transformation needs, increased activity is going to have a knock-on effect to the securities lending desks. And I will cover that in a bit more detail in a later topic, so I won't go into it in too much detail now. But being able to understand the challenges and the differences between the two and the differing pulls, I think is really important.
So pre-trade optimization seems from our clients to be the focus for those who have got really tight balance sheet restrictions. So Martin, your thoughts?
Yeah, so I think one of the key ways of thinking about this, and this is very, very interesting in terms of drawing the difference between derivatives and securities lending markets, is when people are talking about pre-trade optimization, we're really just talking, to follow on from Alan's point, about pricing, about getting pricing more accurate in terms of considering things like XVA, the collateral costs, etc. And it's it's interesting that derivatives has actually reached a point where it's actually it's almost the norm to include these factors in pricing. Securities lending, where everything is still largely done on a bilateral basis, and there are multiple factors that actually influence pricing which aren't necessarily explicitly included, including who am I trading with, what's the collateral mix, what are the operational costs of dealing with a particular counterparty, how likely are they to recall me. These are all factors which are actually part of that. You could call it pre-trade analytics, but I would actually just say pricing, where I think securities lending per se has got a long way along the journey to actually to reach the point that derivatives are now in terms of pricing. When you're looking at the post-trade optimization, I think they're comparing derivatives and securities lending, I think you actually have a very, very high degree of commonality, whatever your objective of your optimization is.
Thanks, Martin. Just a quick one, Ted. Any comments? And we'll move on to the next audience poll.
Yeah, so maybe just to pick up on Martin's last point. I mean, obviously that question around priority, around the pre-trade or the post-trade optimization, probably depends a lot on also who you're talking to. But on if we focus on the optimization of the allocations of the inventory and how you go about prioritizing that, I mean, I think the key there is you need to have some flexibility, right? I guess a good place to start is looking at opportunity cost. So if I'm posting this asset as collateral, what's the potential income that I'm foregoing from it, from the securities lending market, and using that as a means of prioritizing how you do that allocation. You've also got to take into account the relative costs of posting assets to different places. So if you're posting securities to a CCP, there may be a charge for them to hold the securities within the CCP. You're going to also have movement costs that you need to take into account as well. And all of these things kind of build up into that overall cost model. But what's clear from the way our clients operate is that those priorities change. They change certainly between clients. Will have different priorities, but they'll also change over time. So you may be optimizing for opportunity cost at one point, and then switch to optimizing for balance sheet at another time. So you need to have that flexibility in that model and be able to stress it, to be able to look at different scenarios and how they will drive the allocation, and how that may evolve over time.
Thanks, Ted. So our next audience poll question focuses, or is to try and find out in what way firms optimize. So audience poll question 3, what sentence best describes your firm's collateral optimization activity? A, entity-wide cross-product, so that's repo, SBL, and TRS. B, firm-wide cross-product, repo, SBL, and TRS. C, product silo, entity-wide, e.g. within equity finance solely. D, product silo, firm-wide. E, none of the above. And Ted is the key panelist for this question. So over to Ted again.
Oh, all right then. Well, I've not seen the poll results, so I'm going to have a guess because it's almost a truism.
Well, yeah, let's see what your views are and compare them to the results as they come in.
Yeah, what I would answer, Jonathan, is the wider you cast your net, the more the benefits of the optimization that you're going to get. That's pretty self-evident. Now, obviously, a challenge for that is that you've got many firms operating in silos, and those silos might be the product silos that we asked in the question there: securities lending, repo, derivatives, equities, fixed income, and so forth. So there could be product silos, there can be geographical silos. The US is always a special beast compared to the international business, and often with separate silos, and then multi-entity. So if you're a big bank, you're operating in multi-entities. If you're an asset manager, you're operating in multiple entities as well. So that question of silos is a key thing that needs to be addressed. And so you need an operational structure first of all, a business structure where you can centralize that decision-making process around the allocation. So what goes to your collateral, what goes to your lending and your repo and your regulatory capital, and so forth. So that's an organizational realignment or mandate has to happen. And what we've found is actually the bigger the firm, the harder that is, or the longer that takes to get, because the individual silos are obviously more entrenched, more powerful, I guess, and perhaps that's easier in some of the smaller organizations. But once you've got that organizational structure, then you need the data consistent and centralized. I won't talk too much about that because I think we're going to talk about that shortly. But obviously that is a big challenge where you've got different, potentially different systems supporting the different asset classes and in the different regions, all with different ways of representing the same thing. So there's challenges to it, but the biggest benefit is the wider that you can cast your net. Of the current landscape, it's becoming more important to take that broad view. I think with the rising interest rates coming along, the higher collateral requirements from UMR and the constant balance sheet pressure, it's no surprise that many firms and therefore many of us vendors are focusing on this topic right now. I think when you look at how to solve it, there are really a couple of approaches that you can take, and the approach that you take will really depend on your starting point. Now, some firms would have more of an enterprise-wide infrastructure with a single platform covering multiple asset classes. In that case, it's an easier problem to solve. You've probably got all of your exposures and all of your inventory, or at least most of it, in one place. So you may look at the optimization capability of that platform as a kind of an easy win. Because you don't need to be perfect in the optimization. If you've got a multi-silo arrangement where you've got different platforms or no centralized tool, then then you can look at putting something or layering something over the top, and really that should be something relatively lightweight that can gather the inventory availabilities from the underlying system, so your traded positions as well as your actual settled positions, so you know what theoretically you've got, but actually what you do have actually sitting in your box that you can use, and gather together the requirements, the collateral and liquidity requirements that you've got to meet from that inventory, and then perform the allocations. The next step, which I think is something that shouldn't be overlooked, is the actual automation once you've made those allocation decisions to actually automate the booking of those collateral trades, because that's there's obviously, along with, once you start to optimize collateral, the velocity of movements will increase. That can produce some constraints that you have to deal with, and so if you can automate not just the allocation decision, but also the booking of the trades in the downstream systems, then that really gets you to the to a better place.
So we've got the thanks, Ted. We've got the results in, and B, firm-wide cross-product is 45%, which I
told you so.
am somewhat surprised by, because I think that for all the points that you've mentioned, you know, the big firms are going to have some struggles with connecting all the bits together. We see out in the market that there's some overlay solutions now that enable firms to have a single view. But anyway, let's ask Martin to comment on that.
It is something the big firms have been working on, most of them, for at least a decade. So quite a lot of investment has gone into getting to that position. And one of the interesting things, if you look across the different actors in capital markets, is actually you do find some where there is a cost to doing collateral optimization. And I know several firms have tried to offer collateral optimization as a service, and they've actually found the obstacle that there are a certain size of firm where the value from doing the optimization is actually lower than the costs. So it's not necessarily small, it's easy, big, it's hard, because the big ones, as I said, have been putting investment into this for a long time. And for a lot of the smaller firms, the costs don't actually justify the benefits.
That question on cost and benefit is often something that people struggle with, right? That intrinsically, it seems like a good idea to optimize, but how do you actually measure what your savings are going to be before you actually do it? And there's challenges in being able to build the business case to invest in solving that optimization challenge if you can't actually put it up front.
I think the extreme negative sort of situation is where one product silo is going outside the firm to get collateral when another product silo is sitting on collateral, and there's not really a relationship between those two product silos. I think that's where the cost benefit happens if you've got a firm-wide optimization strategy.
But I think it also helps to actually have tools where you can combine the best of people with algorithms rather than just relying on algorithms. And I think that the main reason for that is we don't live in a friction-free world. We live in a world of that there are unknowns. Is that fund manager going to sell off that position? We live in a world of fouls. We live in a world of costs associated with each of those movements. So actually having tools that both pull on the best people as well as the best optimization algorithms, I think, is really important to get to the pragmatic level of optimization for your firm.
Very quickly, Wassel, and then we've got about 20 minutes. So the next question I'd like you to, if we could just keep it quite short, and then we'll get on to the crux of where we're getting to.
Yeah, just to add, of course, the wider the scope of your optimization is, the more benefits you will have from that. But that doesn't mean that you shouldn't begin somewhere. And the key word that was said earlier is flexibility. So if you have a flexible tool that will allow you to achieve certain benefits in the short term and be flexible enough to evolve in the future, to widen the scope, to extend the scope of your optimization, but also to change over time your optimization algorithm, parameters, etc. That would help a lot to have an evolutive tool that will allow you to little by little onboard and additional products, asset classes, and so connectivity and to the existing systems, and real-time, connectivity to have the inventories, the legal data, etc. All that is important, and all that should be the foundation of what could be then used and leveraged little by little to get higher benefits.
Thank you, Wassel. So that leads on to my next question. What challenges do firms face when trying to optimize collateral firm-wide? Now, I've got, just to move things along a bit, I've got a few suggested answers, and then perhaps just throw a few others in. So the absence of digitized agreements, the lack of interoperability of the tri-party agents, transfer pricing, the current technology, consolidated cross-product inventory view. So let's start with Martin on that one. What do you think the challenges are? You're on mute, Martin. Thank you.
Yeah, I think as with the way with panels, I think we've already actually covered most of the challenges.
Okay.
As we've discussed, it's getting firm-wide agreement, getting the data into the right around objectives, getting the data in the right place. It's having the operating model, and finally, it's actually having the having the right technology in place to provide the pragmatic level of optimization.
Okay, very quickly, Gabby.
Thanks, Martin, Jonathan. I see that there really is a need for having a real-time and accurate view of inventory. So in order to correctly understand your collateral needs, you need to have a good view of your inventory by asset class, as well as actually across the venue. I think there's also a need to be able to optimize across different collateral venues. And firms also need to be able to seamlessly, automatically move that collateral around. So understanding that inventory is really key so that firms can actually optimize effectively. And that's in terms of optimizing collateral in order to cover SBL trading, for example. And for example, if you're manually agreeing and booking all of your trades in the SBL world, your view on that inventory is always moving. It's a constant moving target. So that's where things like automated trading platforms, such as NGT, they'll bring in that speed and efficiency to the SBL trade booking process, which is actually helping to give a better view of inventory. So therefore, those optimization decisions in that space can be made much faster.
Alan, your thoughts very quickly, and then we'll move on to the next question.
Yeah, just the one that I wanted of holding of the same data, both in terms of static data and trade lifecycle within the different systems, and that increases the need to normalize. And I guess the point I wanted to raise, like the common domain model that's being driven by ISDA, ISLA, and ICMA, should help that. Different representations of the data, then you need to reconcile the data, and you also need to maintain that when you upgrade any of those individual solutions.
Thank you, Alan. So we'll move on to the next topic. So tri-party to tri-party is a sort of precursor to tokenization, perhaps. So Gabby, would you agree? And if so, why has the progress of tokenization of collateral been slow?
Well, yeah, this is certainly a rife topic. So you only really need to look at industry forum agendas to see just how prevalent that digital discussion is. Topics being raised across the board, it's being raised not just from a collateral perspective, it's being talked about in all aspects, in all facets. There are industry-wide digital working groups. They cover a broad spectrum of digital conversations. We're seeing more and more examples of digital teams within both buy-side and sell-side firms being set up. So that's further demonstrating the focus really that this area is getting. But although there is a lot of focus in that digital space, we're not seeing a rush. We're not seeing that rush to move over to DLT or to tokenization. And I do see that there are several factors at play. It's a pretty seismic shift. It's a big move from what we already know, and it certainly can't be adopted in silos. So pairs of counterparties need to be ready simultaneously. So they've got to move together at the same time. And as we all are fully aware of, syncing up roadmaps across multiple organizations, syncing up roadmaps internally is challenging enough, but then doing that across multiple groups, syncing roadmaps, syncing timelines, technology releases, process changes, that all really brings challenges to the firms that are trying to take this digital step. And we need to think about budgets as well. So from a financial and a regulatory perspective, budgets are really being hammered. There's been many new strategies, new technologies that have had to be adopted from a regulatory perspective over the past couple of years. And the teams as well as budgets are really being put under immense pressure in those spaces. So I do think that leads to some of the delays or some of the slower take up that we're perhaps seeing. I also think actually that tokenization is going to shift collateral management from being a reactive, as it typically is today, to being a bit more proactive, or a lot more proactive. The industry isn't quite there yet holistically. CSDR is going to help to get more to a proactive stance by forcing improved visibility across future settlement ladders. So in order to ensure minimal impact of CSDR fines, firms need to understand what their settlement ladders look like. And of course, what that's doing is it's going to facilitate a much more accurate view of inventory in terms of your projected and settled inventory. So by bringing in CSDR into this fold, actually improved settlement rates will also, well, hopefully the industry will start to see improved settlement rates, but improved settlement rates is also going to give much more accurate views of those inventory. And this is all really leading me towards kind of the idea of standardization. Standardization is key. So in order for this to work, the industry really does need more standardization. We're hearing it all the time, but I just don't quite think that there is a consensus yet on what that standardization looks like. So I'm feeling like that shift hasn't quite got there as fast as perhaps we were expecting, just because as a whole, the industry doesn't really know what it looks like. We haven't yet agreed on that. And to call back on regulation, SFTR, CSDR are paving the way. They're forcing participants to operate better together, but I do still see that there's some way to go.
So, of course, I was just going to say, yeah, Gabby. Yeah, so UMR has been a big driver for collateral transformation, and one of the reasons we want to talk about tokenization is that actually the demand for collateral for initial margin would be met better if it was easier to do collateral transformation. So. Yeah, if you want to carry on.
So I've definitely got some thoughts on that space as well. So UMR is one of the drivers in the collateral space in recent period. And just kind of setting the scene to call back on what Alan said earlier around the increases in IM postings. Over a 3-year period, those stats that Alan provided, that actually represents a 72% increase. So there is certainly much more demand as a result of UMR. More collateral need means increased collateral transformations, increased trading activity adds pressure to both trading desks and also operational teams. So I do see that in this space where there is a significant increase in demand, we do need as an industry to be able to mobilize and facilitate that increase in collateral movements. And the demands really are only expected to increase over the next 6, 12, 18 months. Ted's alluded to this already. We're expecting interest rate increases, and also with central banks planning to taper that quantitative easing, there is going to be a direct impact on collateral and on the way firms bring in their collateral.
And I think one thing we want to mention is that actually buy-side firms are now impacted by UMR with waves 5 and 6, and they will need to transform collateral, and they don't necessarily have the tools for that.
Yeah.
And how do they? Yeah, how can they be mobilized to actually start executing? And that's really where kind of there are automated platforms, there are solutions, there is technology available to firms to actually facilitate these. And of course, as us vendors are always campaigning for, kind of automation helps to lead to standardization. It's all intrinsically linked. And whether that need is in the space of collateral transformations, whether that need is because actually it makes more sense to transact via swap, whether there's just simply a faster need for accurate visibility to margin, especially in EquiLend's perspective, we're ready placed to evolve to whatever those client needs are and to facilitate those transformation challenges.
Thank you, Gabby. Alan, any thoughts?
Said we've seen a huge increase in the interest and development of DLT-based solutions, including Deutsche Börse, ASX in Australia, and SIX, who I understand only last month were granted licenses from their regulators to operate an exchange and a CSD for digital assets in Switzerland. And I think there does seem to be a consensus, or at least an impetus, that collateral management and collateral movements are prime candidates for DLT technology. Again, due to the improved efficiency that Gabby's described. But from my understanding, and maybe I'm out of date, one of the main impediments is that the legal and regulatory framework is not as advanced or as quick to move as the technology is. I'm obviously no lawyer, but I've read a lot of commentary that says, we need a regulatory framework that's common, which seems obvious, but I understand that today it's not even the case across European member states. I believe European Commission have announced that crypto assets are not currently covered by EU regulations, although again I understand that proposals have been made to address this. And I also understand that digital assets are not currently acceptable as collateral under UMR regs. So which we've said is maybe one of the drivers for the collateral transformation at this time. Purely personally, I think the most successful model will be using what the Deutsche Börse have called the trusted third-party layer model. So where you have a current trusted party or parties, like a current tri-party agent, or like the ECB, who underpins the model and then manages the underlying security positions.
Yeah, if I could just add on to that, I think you have to distinguish between the crypto world of Bitcoin and people who actually tokenize existing real-world assets, where both Broadridge and companies like HQLX put a lot of effort and money into actually making sure that the tokenization of what I'd call real world rather than crypto assets is actually done within existing legal frameworks. So you can do it, but you do have to put some legal investment into it. And it is that world is very, very different from the world of Dogecoin and Bitcoin, which is doesn't really fit very well into any regulatory framework. I would very carefully distinguish between those two different worlds.
Thanks, Martin. So we've got 6 minutes. So Ted, 1 minute, and then we devote 5 minutes to the last audience poll.
I agree with Martin about the digitization of traditional assets. Yeah, there's absolutely a role for that, and we're all interested in what the HQLX folks are doing, and I think they're on the panel later, so they'll tell you all about it. That's quite interesting. Just on the collateral optimization topic, really quickly, I thought it was interesting to just highlight one project that we've just done for our global inventory and optimization platform with one of our asset manager clients. Around the what we've just implemented there is an optimization solution that is looking at gathering their inventory across the multiple entities, looking at their derivatives collateral requirements, their repo program and securities lending program, and introducing an automated collateral transformation tool as part of the optimization. So that means actually doing the optimization, we're actually automating the booking of securities, loans and borrows between the entities within that asset manager, so that you get the right assets in the right place without the firm having to go out to the street to do that upgrade. And that's all fully automated, implementing a collateral transfer pricing mechanism. So a little plug for us there, but I think it's quite an interesting project for the Buyside.
Thanks, Ted. We've got 5 minutes left. So the last audience poll question is on ECMS, the Eurosystem Collateral Management System launch in November 2023. What sentence best describes the awareness of the ECMS? So fully aware and impact analysis and planning in progress. Aware but not on the planning radar. Aware but no idea of impact, and not heard of it. So just Wassel's going to speak to ECMS for us.
Yeah, So ECMS is the European Collateral Management System that will go live by November 2023. It is one single platform that will manage the collateral of the Eurozone central banks. A lot of alignment needed there to have one single platform, as Gabi was mentioning earlier. You need a lot of alignment between those central banks to succeed in such projects. It will harmonize the collateral management processes, and it will harmonize the procedures between those central banks, and all Eurozones banks' treasuries will be impacted by those changes, and they have to comply with the ECMS calendar in a certain manner. So what are the impacts on that? So we waiting for the poll results. So basically, you will have impacts on the treasuries, where they will use different instruments to collateralize the financing credit lines that they have with the central banks, like the use of credit claims, harmonizing all that. Impacts will go also on the processes themselves. There are corporate actions. So having a systematic substitution whenever you have an instrument within the collateral assets will not be the case. And there will be a process change around the communication with the third-party agents, with the CSDs and the treasury banks as well. Other implications, like the adoption of ISO 2022 for all the communication with ECMS. So it will be, so that there won't be a use for Swift messages for 15022. So all that makes that, I think that there will be impacts on the different banks, and they need to, at least at this stage, be aware of it. If not, try to look for solutions to manage those impacts. So this is in a short the ECMS project, and maybe waiting for the polls results.
I think they're in, Wassel.
Yeah, so you have that. Yeah, people are aware but no idea of impacts. So 37% aware but not on the radar, 27%. And you have people that fully aware that and they are planning their work on 9%. And not heard of it, 27%. So I think that, the date is November 2023, and people need to begin thinking about it at least now to make sure that they will comply with that.
Thank you, Wassel. So I think we have to round up now. We've got 2 minutes left. So just a quick round the table. Let's start with Martin. Quick sum up. Any thoughts?
Yeah, I think one of the key things that's come out is basically, particularly when we look at securities lending, which is a trading activity, is how many of these trends are actually driving a convergence of trading and collateral management. I mean, securities lending has always been a collateralized trading activity, but particularly when you touch on things like collateral upgrades, that's booked typically by you under GMSLA as a lending agreement. So I think that's one of the, from the perspective of the securities lending industry, I think that's one of the really interesting things that's coming out of the increase in optimization, but also some of the other industry trends driving trading and collateral management even closer together.
Gabi?
I think adoption of standardization and automation in order to support these changing demands, the changing landscape, are imperative.
Ted, 3 seconds.
Securities finance and collateral management are two sides of the same coin and need to be looked at together.
Alan?
I guess 10 years after the G20 summit that initiated both BCBS and IOSCO and SFTR rules, there's still a huge amount of change. Panel would advise anybody listening to make sure their system infrastructure can deal with those challenges, meet the challenges, and take advantage of the opportunities they provide.
Wassel?
I think building the business case, building the business cases of the optimization benefits is a challenge, and we are here to help for that. And I think that we can help, through proof of concepts or things like this, to prove and to help people to build internal business cases.
Thank you, everybody. I think we're at time. I think it's over to Kevin. Thank you.
Thanks, Jonathan. Nicely done. You just about managed to finish on time, and thanks to you and the rest of the panel. I thought that was a great discussion, by the way. It confirmed for me that the subject of collateral optimization has a long way to go yet, so we'll continue to see it on the agenda, I think, for many years yet, by the sounds of things. I also thought it was quite nice that we got a few teasers for the next session, which will be on UMR. That will start at 2 o'clock. So you now all have a bit of time to go and grab a bite to eat or to get a coffee if you're in the US. I realize it's a bit early for lunch over there. A quick reminder to you all, please go and visit the sponsors on the virtual platform. That's always appreciated. And on that note, I will sign off for now and be back with you all in about an hour's time. Thank you.